All right, let's get right into it. Welcome to this explainer, where we are going to dive deep into exactly how the Oracle of Omaha actually built his massive fortune. And honestly, we're going to completely dismantle the modern myth of fast money along the way. Because, when you look at the astronomical wealth of Warren Buffett, it's so easy to assume he must have some incredibly complex, highly guarded secret. But the truth is actually far more grounded than you might think. So, how did he actually do it? I want you to take a second and completely reconsider your assumptions about how billionaires are made. Think about today's financial culture for a minute. We are constantly, and I mean constantly, surrounded by stories of fast money. But Buffett? He didn't invent some viral app. He didn't launch a wildly successful crypto coin. He didn't flip houses, and he definitely isn't day trading from a desk with 6 different glowing monitors. He built his incredible wealth by reading, by waiting, by buying completely boring businesses, and honestly, by doing absolutely nothing for a very, very long time. Let's start with Section 1, the myth of fast money. Cash flow over flashy toys. The reality here is that Buffett's biggest investing secret wasn't luck, and it certainly wasn't about perfectly timing the market. It was pure, unadulterated patience, combined with this really early obsession with how money moved. I mean, picture this. While other kids were solely focused on buying the newest toys, young Buffett was obsessed with cash flow. He was out there selling chewing gum, Coca-Cola bottles, newspapers, rescuing lost golf balls. Get this, he even bought used pinball machines with a friend and placed them strategically in local barbershops. He didn't wait until he had millions to start thinking like an investor. He started small. He learned super early on that businesses make a profit. And more importantly, he figured out that if a single dollar can create more dollars, then time can turn something incredibly small into something absolutely huge. Moving on to Section 2, evolving the strategy. From panic selling to the forever game. Now, you might be thinking Buffett was just born with a perfect investing record. But no, he had to evolve through some very real early failures. After those childhood cash flow days, he hit his early teens and bought his very first stock, a company called City Service. The stock price dropped, young Buffett totally panicked, and the second it came back up, he sold it for a tiny, tiny profit. Sounds okay, right? Well, actually, scratch that. It wasn't okay at all, because right after he sold it, the stock just kept rising and rising and rising. That early mistake, that panic sell, taught him an absolutely crucial lesson. Real money is not made by constantly buying and selling, bouncing from one hot trend to the next. The real money is made by buying something valuable and just holding on to it. He realized the stock market is essentially a giant machine designed to transfer money from the impatient to the patient. Later on, as a young adult, he found an amazing mentor in Benjamin Graham, and then eventually, from 1965 onward, his partner Charlie Munger helped him completely upgrade his entire philosophy. And that early mentorship with Benjamin Graham, who's basically the father of value investing, led to this core philosophy. Do not buy stocks like lottery tickets. Buy them like pieces of a business. I really want you to think about this for a second. If you were going to buy, say, a small local coffee shop in your neighborhood, you wouldn't just blindly throw your life savings at it, right? You'd ask the logical questions. Does this shop actually make money? Are they drowning in debt? Do the customers keep coming back? Is the owner an honest person? And hey, is the asking price fair? But when the average person buys a stock, it's like all that logic just flies out the window. They just stare at a screen and ask, is the green line going up? Buffett learned to step back and ask a much better question. What is this business actually worth? This shift in his thinking was an absolute game changer. Early on, his strategy was just buying cheap, struggling businesses. In fact, did you know the original Berkshire Hathaway was actually a failing textile mill? Literally a declining industry with failing factories. Buffett bought it simply because the price was incredibly low, and he later admitted this was one of the worst investments of his life. Because a bad business can stay bad for a very, very long time. Just because something is cheap, it doesn't automatically mean it's good. Then came what I like to call the Charlie Munger upgrade, great businesses. Munger pushed him to buy companies with strong brands, fiercely loyal customers, and real pricing power, even if he had to pay a fair price instead of a dirt cheap one. That's exactly why he bought into heavyweights like Coca-Cola, Apple, American Express, See's Candies. He wasn't guessing what the stock market would do next week. He was playing the forever game, asking himself if these companies would still matter in 30 years. Let's look at how this all comes together in Section 3, the compounding machine, the unstoppable engine of wealth. To truly understand the mechanics behind his massive empire, we have to talk about a concept called float. This is so clever. One of Berkshire Hathaway's absolute biggest advantages came from owning insurance companies, like Geico. Insurance is a really unique business model. Think about it. They collect your premium payments today, but they might not have to pay out a claim for months or even years later. That massive, gigantic pile of cash just sitting in the middle, that's called the float. As long as the insurance side of the business is run carefully, Buffett gets access to enormous, continuous amounts of capital that he can essentially use as free investment fuel. He takes that float, buys stocks, buys whole businesses, reinvests all the profits, and decades later, you have an unstoppable compounding machine. But here's the catch. What does compounding look like in the very beginning? Zero. Absolutely nothing. When you first start investing and putting compounding into practice, it often looks and feels like nothing exciting is happening whatsoever. You invest, and nothing crazy happens. You invest a little more, still nothing. This perceived zero is the exact reason why impatient people throw in the towel entirely too soon. But just watch what happens as time passes. The momentum completely shifts. In your early investing years, you only see this tiny, almost frustratingly small growth. By midlife, you start to see noticeable momentum building. And in that late life phase, massive, exponential, hockey stick growth. It is truly staggering to realize that the vast majority of Warren Buffett's wealth came much later in his life. The machine literally starts feeding on itself. The initial money earns money, then that new money earns even more money. The snowball starts out tiny, but eventually the growth becomes astronomical. So how do we actually apply this? Let's break it down in section 4, 5 rules for wealth, the boring path to riches. Here is the exact logical flow of how to do this. Step 1, buy assets, not hype. Please don't chase whatever flashy stock is trending on social media this week. Look for real, tangible profits and real customers. Step 2, understand what you own. If you cannot simply explain to a friend how a company actually makes its money, you probably have no business owning it. Step 3, think long term. Buy into a business because it can grow over years, not because you think the chart might tick up tomorrow afternoon. Step 4, avoid unnecessary mistakes. Buffett is famous for focusing heavily on risk. And I don't mean the risk of a daily price swing, but the fatal risk of permanently losing your initial capital. And finally, step 5, be patient. Honestly, this is the hardest one by far because it literally feels like doing nothing. But I promise you, when it comes to investing, doing nothing is your ultimate superpower. Which brings us to our final part, section 5. The Everyday Investor's Playbook, copying the mindset, not the billions. Now, you might be sitting there thinking, okay, that's great, but I don't have billions of dollars, and I certainly can't go out and buy an entire insurance company. And yeah, that's fair. But you can absolutely execute the exact same behavioral shifts. Look at the average person. They want fast money, they crave constant action, they are always hunting for some hidden, secret opportunity, and they let their emotions drive every single buy and sell decision. Now compare that to Warren Buffett's approach. He got rich slowly. He waited patiently. He bought incredibly obvious businesses, literally companies that make soda and chocolate, and he just held on to them for decades. The uncomfortable truth is that building wealth isn't actually a complicated puzzle, but it is incredibly hard. It's hard because it demands that you remain disciplined and consistent precisely when absolutely nothing exciting is happening. To really ground this whole concept, I want to share a quote from Buffett. He once said, "Building wealth is like rolling a snowball down a very long hill. The trick is simple. Start early, keep going, and find a very long hill. You have to consciously stop looking for that one magical overnight win. Read more, spend a little less than you earn, invest consistently in simple, diversified assets, and just step back and let time work its magic." So I want to leave you with this final, provocative thought to chew on today. Take a hard look at your own daily financial habits. Are you trying to build wealth like a trader, frantically chasing the next market move and jumping on the latest trend? Or are you building wealth like an owner, patiently putting the pieces together for the next decade? In a world that is totally addicted to quick, flashy wins, your absolute biggest investing advantage might just be your patience. Thanks so much for joining me for this explainer. I really hope this helps you reframe your entire financial mindset.